Welcome to lesson 1, part 4 of the 8 stock investing categories. In this video, we will talk about turnarounds and speculative stocks. Let's start off with turnaround stocks. These are great businesses that have been hit hard by temporary bad news, such as lawsuits, boycotts, scandals, mismanagement, recession, and so on. I'll give you a few examples, starting off with Boeing. During 2018 and 2019, Boeing was hit hard when on 2 separate occasions, their Boeing 737 MAX airplanes crashed, which led to the deaths of 346 people in total. This led to the suspension of all 737 MAX airplanes and caused the share price of Boeing to come tumbling down. The airline suffered massive losses during this period. Another example is Alibaba, who have been hit hard by the Chinese government crackdown and regulations due to their alleged unfair monopolistic practices. Even though the business is still making profits, its growth rate has slowed down significantly and the share price has dropped by over 60%, which is massive. Companies like Booking.com, the biggest online tour agent, suffered a massive loss in sales when the COVID-19 pandemic was declared. Same thing with Yum Brands, who own chains like KFC and Pizza Hut. Their restaurants were closed temporarily at the beginning of the COVID-19 pandemic. The important thing about turnaround stocks is to determine whether the bad news has a temporary impact or is it permanent. For great companies which are industry leaders, most often than not, they retain their competitive advantage. They remain solid despite temporary financial losses. In these cases, as investors, we know that the company will soon rebound and start making profits again. So when we do our evaluation of these companies, we ignore the period during which the business is experiencing short-term or once-off losses. This will help us to get a realistic picture of the true performance of the business and also its true value. And when we buy these stocks, we always buy when the share price is 20 to 30% below the intrinsic value of the business. This serves to give us a good margin of safety. And in some cases, like Alibaba, for example, the share price can be selling at 40 to 60% below intrinsic value, which is even better for us. But the minimum discount we want is at least 20 to 30%. Patience is obviously important when investing in these stocks, as it may take a while for these stocks to recover and go back to their former glory. It is very important to note that this strategy can only be applied to great companies which are market leaders and still retain their wide economic moat or competitive advantage. Use this strategy only to companies which are a monopoly in their field and so have little or no competition. Do not apply this turnaround strategy to average businesses that have been impacted by bad news, as these companies may never recover. Moving on to speculative growth stocks. These are stocks that have the potential to make a lot of money, but are more risky because they are just starting out. For example, we have great giant companies like Meta, Google, Amazon, which generate massive profits now, but there was once a time when they were still small and upcoming. So certain investors like to buy these stocks whilst they are still young and starting out, and therefore less expensive. They like to get in at low prices before the value of the business explodes up, and therefore causing the share price to fly up as well. But the issue here is that there is no guarantee that the business will be successful in the future. These companies, which are giants now, could have failed and could have been driven out of business by the competition. So they tend to be very risky, these businesses. That is why they are called speculative. As we will learn in this course, when we analyze a company, we want it to have consistently increasing sales, net income, and cash flow from operations. However, this category of stocks is the exception to the rule. These speculative businesses may be generating massive sales revenue, but are not yet profitable because they still have to invest the money that they generate back into the business so as to grow the business. A classic example is Amazon, which only turned profitable after 7 years of operation. Its value and share price has gone up over 15 times since then. Now, because these companies are not making profits yet and generating negative cash flow, we cannot use the conventional valuation methods you are going to learn in this course. For these types of stocks, we use a method called the price to sales growth ratio, PSG in short. And for these stocks, we want the PSG to be 0.2 or less. But more about this in later lessons. When you invest in these companies, bear in mind that they are a higher risk investment and therefore will not pass most of the steps of a great business, which you will learn later in this course. But nevertheless, they have the potential to multiply your investment tenfold over a few years' time. But having said that, you cannot now go and buy these companies because you believe they will multiply your money 10 times. Remember, these stocks are risky. For example, let's say you have 10 speculative stocks. Only one out of these 10 will be successful and will become a great giant. Maybe 3 of them will barely survive and 6 will just die off. So if I buy these stocks, I would only buy 1 or 2 of them and also allocate a smaller amount of money so that if I am wrong, it does not cost me a lot of money. So only allocate a small position on these stocks and cut losses if the price drops below 25% of purchase price or when the stock price reverses into a downtrend.